Share Shootout brought to you by Lion of Africa Insurance, insuring South Africa's future.
What came first, the chicken or the egg? What happened next? I suppose you could say, how long is a piece of string? All of these are insurmountable problems. What we do know, however, is that we have one of the greatest mismatches of share shootout history. One of the greatest mismatches of all time. We're introducing the challenger, weighing in with 3 appearances, 1 win and 2 losses. We've got Sasha Naryshkine from Vestact. Sasha is up against the defending champion with 6 appearances, 5 wins and just 1 loss. He is the baby-faced assassin. His name is Mike Hawort from Applied Capital Insights. He looks like a nice guy, but those of you who watch regularly know he's mean. You're watching Shootout here on CNBC Africa. My name is Bruce Whitfield, and over the next 30 minutes, we will speak more sense than we just did. I'll indulge arguments for and against stock picks, and of course, scientifically choose the winner. And by scientifically, I need to explain this very carefully. It's at my whim. All right, as long as we all understand the rules, that's what's important. Both our guests have pre-picked 3 shares that they're keeping very close to their chests. Neither knows what the other holds. And at some point during the proceedings, they must accept at least one of their competitors' stocks. The longer they leave it, the more likely they are to find themselves in the cul-de-sac of indecision and have to choose something they really don't like. Each has got 30 seconds to argue their stock pick. We interrogate their choice, we make knock-knock jokes about them, and eventually we either shoot down or accept them. That's how Share Shootout is won on arguably the friendliest but most vicious stock-picking show on TV. Yes, it can be both. Let the Share Shootout begin. I think because you're a bit of a loser at this game, Sasha. Big loser. We need to make you go second. So, Mike Hawort, give him some time to think about it and stew just a little bit. Okay, nice new ensemble, incidentally. I like what you've done with it. Your wife clearly has dressed you. Tell me, please,
she'd appreciate that.
Why you like Hyprop. 30 seconds start now.
It's a property loan stock that's converting to a REIT. It's going to change its investable universe quite dramatically. It's a premium quality shopping centre oriented property company. It's got about 94% of its assets are in shopping centres. It owns 85%. It owns 11%, roughly 11% SICOM. It's got things like Rosebank Mall, Hyde Park Centre, Canal Walk.
We have to stop at that point, but yes, certainly very attractive property assets. Explain to us, please, what is the difference between a property loan stock and converting to a REIT? Why would I care?
You would care because one, you don't pay securities tax on entry. Firstly, 2, you get now the company doesn't pay capital gains tax on disposal of properties. So that should enhance things a little bit. And you now harmonise across about 25 countries in terms of the standardisation of REITs.
Okay.
Now the importance
a real
of
estate
that,
investment trust, that's what REIT stands
exactly.
for, right? Okay. So it's in a trust structure as opposed to in a company structure now, which then makes it far more tax efficient from an investment point of view?
But also, very importantly, it actually now brings it onto the radar screen of many international investors because now it's a much more transparent, understandable system. And I think on top, what it's going to do is it's going to be very good in terms of internationalizing the view of our REITs.
Okay.
We can have about the 8th biggest REIT market in the world.
Okay, I've not REIT once. Now, Sasha, noddy, because you're sitting nodding and agreeing. Does that mean that you like the concept, you like the idea of Hyprop? Because you're sitting nodding in agreement, which implies to me that you quite like this as a first pick.
I worry that as a collective, they've run really hard. And if you think kind of in the medium term, where to next for interest rates, even though we might see a reduction in interest rates, after that, you're probably going to see higher and higher rates. And I wonder
quite possibly, but when does the rate cycle turn? The rate cycle turns at a time of sort of the black swan moment that we can't yet foresee. So that could happen in a month's time, it could happen in 6 months, or even 2 or 3 years' time. The risk of a cut in interest rates, surely, right now, considering what's going on globally, is higher than the risk in an increase in interest rates.
Yeah, you're probably right. And in fact, that has been the move from several central banks lately. But in a South African context, if you're looking for an investment over the next 5 years and you haven't owned these, well, gee, then you've missed out substantially. My only concern is also that their tenants are probably under increasing pressure. Retail sales were a little bit of a surprise.
I don't know when last. I mean, clearly you don't shop in Hyde Park or Rosebank, but
South Coast Mall.
The South Coast Mall is grateful for your patronage. But when you look in these shopping malls, there is a queue of people prepared to pay extraordinary amounts of rent simply to be in these premier properties, because I think those retailers feel that these are the defensive properties to be in.
Yeah, I think undoubtedly. You know,
your arguments are falling apart faster than
I'm just going on a pure
shirt.
price point. This shirt's not so cheap. Come on.
Give me a sense of it. You give me a reason as to why you would be cautious, simply from a timing perspective. You like the REITs, you like Hyprop, good quality business, good underlying assets.
Yes.
The tenants are stressed. If you haven't been in these for the last 5 years, you've missed out on 300% gains.
Yes.
And you wouldn't buy it now. Because
the timing is incorrect. I just think from a price point of view, and maybe over the next 18 to 24 months, we will get indication that the rate cycle is stopped.
And you're shooting it down.
Yes.
Okay, nice way to start. Thank you.
I can't respond.
No, you can't. You've had your time, and we have to move on. I like your pick, for the record. Okay, so on to Sasha Naryshkine from Vestact. Oh, this old chestnut. 60 billion rand food produced. 60 billion rand, is that what it's worth now? It's extraordinary.
Yes.
30 seconds. Why do you still like Tiger Brands, talking about timing?
Recent upgrade from Goldman Sachs, and with looking for offshore institutional money to find a home in an African food producer that's done it properly here in South Africa. A larger portion of their sales are coming from outside of our borders, and they're entering into equity stakes in existing businesses. I think they might have maybe overpaid a little bit for Dangote, but getting a foothold in Africa's biggest and fastest growing economy, I think that's a net plus. Very inventive team.
There we go, very good, and very well done in the 30 seconds.
Thanks.
Tiger Brands, 316, 318 rand a share, run hard, branded consumer goods, sectors under pressure. Do you like it? Not trying to lead the witness at all.
No, I think I have a better one.
Okay, you have. Okay, let's talk about the food space then. What would you choose in that food space as opposed to Tiger Brands?
From a value point of view, but also a positioning in terms of the consumer slowdown, because the consumer slowdown is uneven. I would want to be oriented towards the higher end of the consumer market,
so
because it's more robust.
AVI, would you?
So I'd be going into AVI.
What about, here is a crazy idea, and we will talk about your share, it's boring, but we'll talk about it in a second. What about Zeder? I will say Zeder because that's the way Janne Mouton would say it. Zeder is in the agricultural space. It's an Africa expansion story. It also happens to have a stake in Pioneer Foods. It's also interesting. I've been talking to a lot of people about the food sector recently, and uniformly, the pick that's coming out, if you look at the entire food value chain from production to processing to retail of food, Zeder comes out strongest.
Pioneer has actually done quite well, but I think you get such a diluted entry. Quite frankly, I mean, why not? I mean, if you want to get a more direct entry, why don't you get into Tiger? You get the grains component.
So you like Tiger then?
It's a very good company. I agree with Sasha. I think that they have overpaid for those Nigerian assets, and they're not coming to life quite as quickly as we all thought they would 2 or 3 years ago.
And that's a valid point as well, because everybody who's going on to and wanting to do business on the African continent outside South Africa is having to pay an enormous premium. We're seeing it in financial services. If assets were reasonably priced, they'd all be bought by now, and the owners of those assets know it. They are sitting in the pound seats and can wait for buyers to come along and be paid the price that they want for their assets.
Yeah, but the question is, do you get in now, or do you wait for those assets to appreciate in 5 years' time, 5, 10? The way I see it, in the next decade, Tiger are going to be competing with Unilever, with Nestle across the continent.
Have they really got the capacity and the skills to do that?
I think they do, because they understand Africa. Everyone always forgets that there's just the South next to Africa. They've operated in this environment for the better part of 100 years. They understand.
People have lost many billions of rands making that assumption, though, Sasha, as well.
Yeah, but they're going to places like Australia and the United Kingdom, where it's saturated. If you have a look at the growth in sub-Saharan Africa, it's in excess of, 6-7%. So just to be operating in those environments where the base is really low, they just need to be participating, to be perfectly honest. And having done the basics right, I don't care what they paid for this, because remember when MTN bought a cellular license in Nigeria 12 years ago, everyone, they've completely overpaid. Well, the rest is history.
There we go. Do I smell an oily rag as you clean out the barrel of the rifle to cock it and shoot it down? Or is there a tenuous acceptance that this is maybe not the worst pick that Sasha could come up with?
And it's a fishy, oily rag.
You're shooting it down. You're shooting it down. Sasha, you have been blasted into oblivion on Tiger Brands. Yeah, I think you might regret that one. Let's move on then to your second pick, Mike Hawort, because as you've mentioned, your favorite food stock, of course, in this space, AVI. It is a high-level competitor to Tiger Brands. You've given us a little taste of why you like it, but give us 30 seconds worth, starting now.
It's a branded food and beverage and fashion company. 41% is fashion, 59% of operating profit comes from food and beverages. It's in basically beverages, tea and coffee, and all the branded versions thereof. On the fashion side, it's been moving increasingly into high fashion, particularly in the big malls, with 80 Spitz and Green Cross they've recently acquired. And then in the other parts of the food business are I&J on the frozen food side.
Okay, fine. There's a nice, strong, compelling argument, but you can't expect him to actually know this company because it sells in high-end retail, expensive clothing, all of that sort of stuff. This is a boy from the Eastern Cape, from the wrong side of the tracks, unfortunately, in Grahamstown. But let's move on to the focus, which is AVI. Is it one that you can stomach, Sasha?
Personally, I don't wear a blue and a red Carvela, which has been, there's a certain subset of South African demographics who participate in a culture.
But there are enough people who do wear blue.
Beg your pardon?
Who do wear those blue and red Carvelas, who do have a sense of apparent style, who are prepared to waste that kind of money on outward finery.
I think so, and AVI is a business I've always liked it. I remember an old client said to me once when he was getting mentorship in the equities market, someone told him, buy the tea and biscuits companies because you can basically fall asleep. Now, that's not the part of the business that's done really well for them recently, and when they entered into buying Spitz, they stressed that they were a brands company, and I think that's obviously held them in really good stead.
That was a really hard sell at the time, and I remember them going into that space and people going, are you crazy? What do you know about selling expensive shoes? And the great irony is that is where the huge margin is being made.
They know about managing brands.
Yeah. So is it one that you like enough to accept?
Yes, I'm going to agree with that.
So even though he criticised your Tiger Brands pick, it's in the same sort of space.
I don't care what he does, Bruce. I mean, I care about what I do.
Oh, okay. That's a very good. So why then did you choose Tiger Brands over AVI?
Just in terms of size and space and probability to be able to grow a little bit quicker. I think AVI at that kind of fashion element are maybe going to start to see headwinds, and we've seen that in the middle income South Africa start to struggle. The high-end, really high-end brands. Because if you have a look at who the customer is, that matters more. I'd rather choose Woolies in that sort of space, but Woolies gets snapped up on this cycle every single time. Okay,
so AVI gets the big thumbs up. Well done, Mike.
Can I make a point that a lot of the African, the more wealthy African consumers are actually coming down to South Africa to shop at our Hyde Park kind of malls, and they're buying these kind of
I wondered
products.
who was buying that stuff because you're going to be crazy. Anyway, right. Let's move on to Sasha, your second pick. Now, this is an interesting one because for a long time, this company has done absolutely nothing. It's got a very complicated management structure, remuneration structure, which I've tried to understand and have sacrificed many hours of valuable time that I'm never going to get back. So you better be able to explain to me why you like Brait in 30 seconds.
Because I think it really, in essence, it's transformed to a retail company. So, 60% is obviously Pepkor. What I like most about it is that Christo Wiese will sweat every single cent that he's put into this business. So in terms of the reorganization into a foods and lower-end clothing brand, value for money, they've been able to transform the company but not get the rating that I think they deserve in the coming months, and we'll see results from them shortly.
Okay, now here's an interesting one, because this is the opposite end of where you're talking about with AVI, because Pepcore is a substantial asset now within the Brait since Christoph has come into the fold there. We talk about the vulnerability of people who no longer have the same sort of access to microloans. Those who do have microloans, many are massively indebted and are the subject of garnishee orders. We're seeing that happen across lower income echelons in South Africa. Is Brait such a bright idea?
I think as a private equity company, it's a great company. I think what they've done with it has been superb. The dominant asset at the moment is at the bottom end of the retail market. And that's the end of the market I'm trying to avoid at the moment. Just because I do think that the retail slowdown is completely uneven, and that the bottom end are facing a much tougher time than the top end are. So my migration in terms of the consumer spend is much more towards the top end.
What about, though, the argument that the mass market in South Africa, say that Mr. Price market, people who used to be in the Woolworths market go to Mr. Price, people in the Mr. Price market have to go somewhere else, they going into the Pepcores. There is almost a safety net. Everybody who's got a job needs a T-shirt. If you can't afford the Mr. Price T-shirt, you'll go to Pep and get the Pep T-shirt. Isn't there an argument for that low catchment area?
I think there certainly is, yeah. And you know, in that sense, I guess it's a pretty solid kind of investment in this kind of environment, though. Would it be going anywhere in particular? I don't think so. I think Pep is. I mean, again, I think they've probably tidied it up really nicely. But I'm not sure it's going anywhere at this particular point. So,
can you, considering that number three, maybe a bit of a dog, can you, in any clear conscience, really shoot it down? It's safe. It's not particularly adventurous, but it's safe.
That's number three, is it?
That's number two.
That's number two.
Number three may be a dog. Number two is Brait. Do you like number two? Will you take Brait or will you shoot it down?
I mean, I do. I think what they're doing in private equity, I think as a private equity company, it's a great company. I'm not convinced about Pep at this particular point.
Are you shooting it down or
no.
are you taking it? You're not shooting it down, you are shooting it down?
Yeah, I'll go with it.
You're going with it, you're taking it. Oh, he's a sucker for a good story. Thank goodness for that. I'll tell you what, he's a reluctant acceptor of Brait. But Brait, great private equity business, and of course, has got some very interesting underlying assets. A short break, but when we come back, I'll remind you what these two Einsteins have chosen so far. It's been a very close battle, and everything is going to hinge, quite frankly, on the third picks this evening. Stay tuned.